So the S&P 500 opening at a record today. Let's get more on the markets from Ryan Bushell, Chief Executive Officer and Portfolio Manager at Newhaven Asset Management. Your quick thought on the U.S. markets. Do they feel bubbly to you?
Well, I mean, if people have seen me, they've been feeling bubbly to me for quite some time. We're back to the highs we reached earlier this year. But interesting, if you kind of zoom out on a one-year basis, it's the TSX that's up 22% year over year, and the S&P and the NASDAQ are both up kind of 12 to 13 and less than that in Canadian dollars, with the Canadian dollar rallying a bit on a one-year basis. So, you know, the small picture is, yes, we're back to all-time highs. To me, on the long-term S&P chart, this could represent a double top if you're a technicals person, but we'll just have to see how that plays out the rest of the year.
You mean the February peak and now a new peak? And
right.
Is that bad sometimes technically?
You know, it depends. If it pushes through it, obviously, then it pushes through that resistance. But you know, that's where the story's yet to be written there. But I'm always interested to see when you get a technical formation like that, combined with when the fundamentals are kind of telling us, hey, consumers not doing so well. We had the PCE data out of the United States today. Consumer spending was weaker than expected, and personal income was weaker than expected. So we're seeing some signs of economic weakness kind of broadly through the economy. And but the market, you know, is shrugging off everything it looks at. So, you know, that's the world we live in today.
You are concerned about the housing sector in Canada, among them unsold condos or demand collapsing for condos in Toronto, perhaps.
Yes, yeah, and so again, there's a number of signs, right? And if you look at you know, Dow theory, the transports, FedEx reporting last week. If you look at how the rails are performing, there's definitely some issues in terms of goods demand. And in Canada, a big economic sector is the real estate sector. It's our biggest contributor to GDP, you know, alongside oil and gas. And the real estate sector is sputtering. And this has been kind of the dog that hasn't barked for over a decade. So there's a lot of complacency here. But I keep looking at, you know, anecdotally hearing new sales are plummeting. That means high-rise construction, which is a huge employer. You know, there's things being finished, but once those are finished, there is not a new round of pre-sales to fund new projects, so that is likely to come off. And we're still facing that refinancing wall. You know, we talked a lot about it in 2022 when rates rose off the bottom and said, you know, come mid-25 into mid-26, we're going to have all these 5-year mortgages that were set at extremely low rates refinancing. We're just getting there now, right? It takes a long time to actually get there. So I have trouble squaring that, you know, with how the Canadian banks are priced, for example. So there's a lot of things out there today that to me look vulnerable. At the same time, you've got, you know, however many $1 trillion in treasuries that's no longer investable, and the cash has to go somewhere. So I'm conscious of that as well. So for our clients, we just try to stick to companies that have good fundamental basis, are not overly expensive, pay a good solid dividend that helps to supplement the total return, and can survive a downturn if we do get there.
Sorry, what was that about treasuries being uninvestable?
Well, if you look at the way the treasury market has gone,
the U.S. Treasury
market. U.S. Treasury market, you know, you're $36 trillion in debt, no end in sight. Now the tariffs are coming off, which is fine, except that they're also trying to pass a tax cut bill, which is, you know, where is the funding going to come from? The funding, in theory, was supposed to come from tariffs to help fund some of the government deficit. So that deficit looks poised to expand rapidly, and that's without any sort of economic problem in the projections. And so that makes the treasury market very difficult to invest in. If you look at how they're issuing treasuries, it's all at the short end. A lot of it is bought by, you know, hedge funds rolling for basis, which is a leveraged market. So the average investor, you, me, pension funds, et cetera, are owning less treasuries. So therefore, that money has to go somewhere, private equity, public equity, and other types of investments, which is helping to support valuations in a world where, you know, the last 40 years, we had treasuries coming down from, you know, 18, 19% all the way down to zero. That fueled nice returns for treasury investors that they could compare alongside equity returns. Now we're getting back into, ironically, even with a higher base rate, there is no alternative type of market. And so, you know, when people say, and this is what's making our job very difficult. We are fundamentally based. We are concerned about some things we're seeing. However, you have a lot of capital out there that needs a home. And so that's to me, why we're seeing the levels we're seeing on the markets despite all the concerns that are out there.
We're tight for time, but talk about a few stock ideas, if you would, Ryan. Pembina Pipeline.
Yeah, so again, going to some companies that have good fundamental basis and are kind of trading in the middle of their range or lower end of their range. We can't figure out why this one's come off so much. It was $60+ late last year. Obviously, there's some issues on the Alliance Pipeline and the tolling arrangement that's going to happen there. But to me, that's relatively small compared to the opportunity in front of them with natural gas volumes in Western Canada poised to grow pretty significantly through the back half of this decade with the LNG projects that are coming on, including their own LNG project. Oh. So, you sit here and you collect a 6+% dividend yield with Pembina Pipeline, and I think you'll be pretty happy 5 to 10 years out.
I'm showing 5.5% right now, but certainly in that 6% range, yeah. Your next idea, and I think I'm not sure if we've discussed this with you before, Saveria, they convert vehicles, for example, to help people with less mobility. Yes,
but the big thing for them is aging at home products, so home elevators, stair lifts, things of that nature. This company, again, if you look at the chart there, was in the mid-20s last year, and then we had the tariff news. They're in the middle of a corporate reorganization around how they're working on their manufacturing, delivering higher margins, delivering better revenues, better sales, and all of that's actually going quite well. The sentiment on the stock that took it down to $15 in April was purely related to the tariffs, and now it appears the tariffs are going away. They're going away for in various for various countries in various different ways, but for this company specifically, we don't see a huge tariff risk even if they were enacted, and even less so now. So to me, you're looking at a really good setup for that company over the next 12 months.
I have a dog that doesn't like going up the stairs, but fortunately, I can carry her. She's 10 pounds. I don't need a stair lift. Acon is your final idea. Nuclear franchise, among other things.
Yes, and again, so that is the big story with Acon. They've had these legacy projects, especially the 2 LRT projects. I was driving along Eglinton Avenue the other night and looking over at the LRT project and going, let's get that thing up and running, please. But it will eventually get up and running, and those will kind of fade into the background. And as you point out, what's coming is a big nuclear cycle that I think is going to last quite some time. And Acon will be involved in various quantities, obviously first and foremost at Bruce, where they have ongoing contracts. They do have the contract for the small modular reactor.
Oh, in the Darlington. New one? Oh, okay.
We'll see how that goes. That's an unproven thing. That's supposed to be the first of its kind in North America.
It's them and other people.
Them and SNC are the two main, Atkins Realis. But and you will see, I think this is a theme and it'll actually play out on both sides of the border. They're heavily working in the U.S. now alongside Oaktree Capital to gain contracts down there as well. So I think you'll see this to be a sustainable story for Acon going forward. And again, it's trading kind of in the middle of its range with a nearly 4% dividend yield.